The last week certainly has been a volatile one, with an overload of information, both locally and globally, for markets to digest. Markets remained in a risk-averse mood and equities have fallen sharply. The Aussie dollar is also underperformed, being the weakest G10 currency this week. On global events, the week started with optimism, with the Trump-Xi meeting at the G20 agreeing to a ceasefire and the US to hold off imposing further tariffs, and in exchange China will purchase a very substantial amount of US goods. This optimism lasted a mere 24 hours, with markets finding fresh reasons to worry about the trade outlook, as Trump tweeted he is a tariff man. Further intrigue was also raised with the arrest of the CFO of Huawei, seen as indicative of further strains in US-China relations. These trade concerns and fears over the growth outlook rattled equity markets, which fell heavily during the week. This uncertainty also raised doubt over the Fed tightening path for 2019, with market pricing now questioning whether the Fed will continue its tightening plans into 2019. This revised outlook saw bond yields fall sharply lower, with benchmark US 10-year yields falling under the psychological 3% level. Now, with all this global action, Australia also had an incredibly busy data week, so we'll focus on the key data release, which was Australia's GDP. Q3 GDP was reported to have risen just 0.3% for the quarter versus a 0.6% consensus forecast. Deepening the disappointment were downward revisions, leaving the annual growth at 2.8%. The 3.4% we saw in Q2 was revised down to just 3.1%. The details weren't encouraging either. Business investment fell and consumer spending was weak, rising just 0.3% for the quarter. This weak GDP data, combined with global moves doubting Fed tightening, has seen interest rate markets remove all pricing for the RBA to raise the cash rate next year. Before this data, on Tuesday, we did have the RBA announce its final decision for the year, where rates were left on hold as unanimously expected. The RBA reiterated that the Australian economy is performing well, although they did express concern about signs of a slowdown in global trade, partly stemming from the ongoing trade tensions. But overall, there were no major surprises in the statement, and this marks yet another calendar year of rates on hold, which we expect to again be the case in 2019 and indeed 2020. Also on central banks, it's worth mentioning Bank of Canada, which this week held rates steady, but indicated a much more cautious outlook, remembering that they had been one of the more advanced in tightening, with 3 hikes this year, yet they too signalled growing caution regarding the outlook. Lastly, on the global front, Brexit continues to throw surprises, with growing talk of a second referendum as the Brexit bill is due to be voted on next week. The pound has actually been flat on the week, but UK equities, for example, are down 5%, with the index trading at levels below those seen in 1999. All up then, it has been a very volatile week, and with the focus on trade and growing domestic concerns around the consumer and housing market, the Australian dollar has understandably been weak. Looking ahead, this may continue, although the US dollar has lost considerable yield support as markets debate the 2019 Fed outlook. The December Fed meeting will be the next critical event for markets and will shape early 2019 direction. We'll be back to talk to you about that next week.